Welcome to Lesson 2. Today we cover the framework that sits beneath everything else in this module, the Profit First system. I want to be clear up front, Profit First is a book by Mike Michalowicz, and I strongly recommend you read it. What we're doing today is teaching you the principles in our own words and adapting them specifically for real estate commission income, because the standard setup needs some modification to work for how agents actually get paid. Profit First was published in 2014 and has become one of the most influential financial frameworks for self-employed professionals in North America. The insight at its core is simple. Most business owners run out of money not because they don't earn enough, because they spend whatever is available. When money is in the account, it gets spent. Profit, the thing that is supposed to be the purpose of the whole enterprise, is treated as what's left over after expenses, which means it almost never exists. Profit First flips this completely and does it through a structural change rather than a behavioral one. That is why it works. Let me show you the formula change, because this is the heart of everything. Traditional accounting says sales minus expenses equals profit. Here is what that looks like in practice. Money comes in, bills get paid, lifestyle costs get funded, and at the end of the month you hope there is something left. There rarely is. Profit First says sales minus profit equals expenses. You take profit first before expenses. You take tax first before expenses. You take owner pay first before expenses. Then you run your business on what remains. The formula is the same math, just a different order. But that different order changes everything about how you behave with your money. Why does the order matter so much? Because of a principle called Parkinson's Law. Work expands to fill the time available. Applied to money, spending expands to consume the funds available. When you have one account, every dollar in it feels available for spending, even the dollars earmarked for tax. When you have 5 accounts and your tax money is physically in a separate account, it is no longer psychologically available for spending. You cannot accidentally spend your tax money on marketing. The separation removes the temptation before the temptation has a chance to arise. This is why Profit First works where willpower-based budgeting does not. Let me walk you through the 5 accounts. Account number 1 is income. Every dollar lands here first. Commission payments, all referral fees, everything. Nothing is spent directly from this account. It is a holding account only. Account number 2 is profit, a separate savings account, ideally at a different bank. This grows your wealth. You draw from it quarterly, not monthly. Account number 3, owner's pay. Your personal salary, consistent, scheduled, regardless of deal flow. Account number 4, tax. Your most sacred account. Every dollar here belongs to the government, never touched for any purpose. And then account number 5, your operating expenses. Your business runs on this account alone. Marketing, photography, licensing, your CRM, your vehicle. If the money is not in this account, you do not spend it. The standard Profit First setup assumes relatively consistent monthly revenue. Consistent income is anything but consistent. Here are the 3 adaptations that make this work for real estate agents. First, allocate on receipt, not on schedule. When a large commission lands, move the money immediately. Do not wait for the 10th or the 25th of the month. Second, Add a sixth account, the slow season reserve. In strong months, allocate 5 to 10% here. In slow months, transfer from this account into owner pay to maintain your salary. Third, start small. If your current income cannot fully support all 5 targets simultaneously, start with the tax account and 1% to profit. Build from there. The sequence matters more than the percentages. Now let me give you the real estate agent specific allocation ranges. In the early stages, your first 2 to 3 years, start with 1% to profit, 50% to owner pay, 15 to 20% to tax, and the remainder to operating expenses. Do not let perfect be the enemy of getting started. 1% to profit is almost nothing in dollar terms, but it builds the habit, and the habit is more important than the amount in the early stages. As your income grows and your slow season reserve is funded, increase the profit allocation by 1% every quarter. The target for an established agent is 5 to 10% to profit, 40 to 45% to owner pay, 20 to 25% tax, and 20 to 25% to operating expenses. The Profit First framework does not require more income or more discipline. It requires a different structure. Take profit first. Take tax first. Take owner pay first. Run your business on what remains. Structure replaces willpower, always. 3 actions from this lesson. First, read Profit First by Mike Michalowicz this week, or start the audiobook on your next drive. Second, calculate what your Profit First allocations would look like against your average monthly commission. Just the math. You do not need to implement the full system yet. Third, open a separate savings account and label it tax. Transfer 15% of your next commission payment into it immediately. Do not touch it. That one account, that one action, will prevent the most common financial crisis real estate agents face.